Hello, everyone, and welcome to your Glassnode on-chain 101, where today we're going to be exploring the fundamentals of proof-of-work mining. Now, mining is one of the most interesting but probably least understood components of the Bitcoin network. And what we're going to explore today is some of the dynamics about how the mining industry operates and how that then manifests in these metrics. And we can actually track and see where the industry is at, whether it's currently in a period of high profitability or whether it's currently experiencing significant income stress, and then what that means for the market moving forward. So what we're really going to explore in this session are these mining dynamics and how we can really track them using on-chain metrics. So we're going to talk about things like understanding difficulty, block intervals, and how that is then calculated into the estimate of hash rate. We're going to look at miner revenues and profitability and various metrics that help us track this. We're going to particularly look at miner capitulation cycles. As we know, the coin price is going to influence miner revenue, so therefore they are also subject to the cyclicality of these markets. And then we're also going to look into some advanced modeling of some of these minor cycles and divergences, things to be paying attention to when we start seeing a divergence between metrics, what that may mean moving forward. So just before we get started with some of the metrics, I know that some people who are watching this clip may not actually understand the basics, the very, very fundamentals of what Bitcoin mining is. So let's start with a very, very simple overview of what's actually going on when it comes to Bitcoin mining. So we really have four different elements that we're going to focus on here. We have the Bitcoin nodes. Now these are elements, they can be Raspberry Pis, they can be laptops or computers. They broadcast transactions and verify blocks. So whenever you use a Bitcoin wallet, it will talk to a node and then that node will broadcast that transaction. Now the miner's job is to solve the blocks and actually put all of those transactions into a block and build the blockchain. Now, once they've solved the block, the nodes will come in and actually verify it. So the nodes are the ones that are checking the rules, and the Bitcoin miners are the ones that are putting the transactions into blocks. Now, the Bitcoin protocol will then pay these miners for their service. They need to expend power and actually deploy hardware and capex to this problem. So therefore, the Bitcoin miners are paid with the Bitcoin block reward, which consists of both the subsidy and the fees. And then we also have the protocol difficulty, which we'll talk about a bit later on. And this is really regulating the puzzle complexity that the miners must solve. Now, let's actually talk about this from a linear standpoint. What is actually going on with this system? So let's imagine we have two blocks. This is at the end of the existing blockchain. These have been solved, and these contain the confirmed transactions. There's a whole blockchain built behind this, but we're looking at just the last two blocks that have been confirmed. Now, as a result of this last one, it's paid these miners over here. These are the ASIC rigs. It has paid them the block reward consisting of the block subsidy and the fees. So this is how the miners are incentivized to continue to mine on the chain because they have power input costs. They also have to buy their hardware. They need facilities. There are costs associated with it. And this is why the block subsidy and the fees are there to pay the miners. Now, at the same time as this is happening, we have a network of Bitcoin nodes. These, as I said, these can be Raspberry Pis, laptops, they can be computers, whatever they are, that are running the Bitcoin software. Now, they have two jobs. They broadcast transactions into what we call the mempool. This is kind of the circulating pool of all the transactions that want to be confirmed. And when a block is mined, they verify that all of the transactions in that block followed the consensus rules, that they didn't double spend, that there wasn't any theft. They essentially are the ones that check to make sure that the miners are not cheating the system. So from this pool of transactions, they have all got a transaction fee. Different ones will be paying a different transaction fee depending on how urgent it is to get solved. So what's going on is that the miners have this pool of transactions in the mempool, and each individual miner, I've just marked out 3 here in red, yellow, and blue, but there are obviously many, many miners out there. Each one selects from the transactions that are currently waiting to be confirmed, which ones are going to pay them the most. They look at all the transaction fees, they look at the limit that they have on the block size, and they can only fit so many transactions in that block. So they select the ones that are going to pay them the maximum amount for that particular block. Now, what is going on is that all of these miners are trying to solve a complex mathematical puzzle. They're trying to solve a SHA-256 hash. Now, what they're trying to do is solve a puzzle that is as difficult. The way to think about this, it's like finding a needle in a haystack where the haystack happens to be about the size of the universe. So if you took every single person on the planet, it would be them guessing every single second, multiple quadrillion guesses of this SHA-256 hash. So it's a very, very complex puzzle solving many, many repetitions. And each one of these miners is trying to solve and find the answer to this puzzle, because the one that does solve the answer to that puzzle is able to put their selection of transactions into a block, get paid the block subsidy and the fees. And the moment that that happens, when this block is confirmed, all those transactions go into it, they become this last orange block here, and the process repeats. And on average, the reason that this protocol difficulty will change up and down is to try and regulate the 10-minute block time, which we will talk about momentarily in all of the charts. So hopefully that's a bit of an overview of how Bitcoin mining works, a bit of a crash course in case you haven't heard it before. These are the different components. The miners are competing to solve blocks so that they can get paid the reward and the transaction fees, and the nodes are then broadcasting the transactions which can then be selected to go into that block. So what we're going to start off is probably the most well-known mining metric, which is mean hash rate. And we have this plotted out in two different scales. The one in the left in blue is in a linear scale, and you can see that the previous history is essentially collapsed down to not much like the price chart. When it's plotted out in linear, you lose the early years up to about 2017 onwards. Now, on the right-hand side, we then have it plotted out in logarithmic scale, where we can actually see the expansion of hash rate. And this is a result of various mining hardware upgrades. So initially, when it was just Satoshi, Bitcoin mining was performed only using a laptop or a CPU. And over time, that started to move into the GPU phase, which is a graphics card. It has a dedicated ability to process just graphics. So it's much better at doing singular tasks, where a CPU is more general. So we saw an expansion of hash rate, particularly through the 2011, 2012 era. We then moved into this phase where we had what we call FPGAs, which is these programmable chips that can also do one particular task, but they're programmed to do so. So they're not designed for that particular task, but they can be programmed to perform a specific task. And we saw an additional expansion. However, that phase really didn't last very long before ASIC chips, application-specific integrated circuits. They started to come to market in late 2012, and we can see this logarithmic or this massive expansion of hash power. So this is the growing efficiency of machines coming to market, and Bitcoin has gone through many cycles, and you can see it generally goes through these large expansions of hash rate. During bear markets, when there's less capital available, it starts to plateau, and then as the bull market kicks back in, we see yet another expansion. So we can see that it is quite volatile on a linear scale. You can see here in May 2021, where we had that event where many of the miners were forced to leave China. They were 52% or thereabouts of the overall hash power. We have since seen a recovery of that, but you can see that it is quite volatile over time. But that's the fundamentals. Let's kind of step through some of the building blocks, because hash rate is actually an estimate. It's not something we can measure from the chain directly. We actually have to calculate it from two other metrics. So the most fundamental metric when it comes to the mining space is called the protocol difficulty. Now, this is essentially the complexity of the puzzle that Bitcoin sets for miners. Now, the way the difficulty works is that every 2016 blocks, which is approximately 14 days, the Bitcoin protocol looks at all of the blocks mined in that window, and it looks at the timestamps between them. And the target is that those timestamps should be, on average, 10 minutes or 600 seconds. Now, when there's more miners coming to market, or the hash rate is increasing, the amount of machines that are on there, the efficiency of the machines has increased, what it will do is it will wind up the difficulty. It will make the puzzle harder to solve. Now, this puzzle is akin to trying to find a needle in a haystack, but in this instance, the haystack is about as big as the universe. We're talking about quadrillions and quadrillions of guesses per second that are being performed by these machines. So what we see is that over time, difficulty has been on the way up. We can see periods where it starts to pull back. This is generally towards later stage bear markets, and we'll explore this in more detail. But this is when mining equipment is being turned off as a result of that financial pressure. You can then get these expansions when more miners, literally in number or in efficiency, are starting to come. They're more efficient miners, so they can do more computations per second. And that becomes part of this industry of competitiveness. These miners are competing to solve blocks. The puzzle is increasingly getting harder. And what this essentially does, by the puzzle getting harder and keeping block time at 10 minutes, it keeps that supply curve nice and clean. We have this deterministic supply curve where we can estimate Bitcoin's inflation rate and the amount of coins issued per day well into the future. That's really what the difficulty protocol is doing. By ensuring that the overall block time is within 600 seconds, the puzzle adjusts up and down depending on the observed block times. Now, this is where we move to the block interval. This is the second piece of the puzzle that can be directly pulled from the network. So we can observe difficulty. It's encoded into each block, what the difficulty is and how much accumulated work has been put into that chain. This is how we know that the blockchain, how it keeps consensus, called Nakamoto consensus. The protocol and every single node in the network can look at all of the blocks, all the different versions of the blockchain, and see the one that has the most accumulated proof of work. And it uses that difficulty function to work this out. Now, the block interval is the observed performance. Every time a miner solves a block, they encode the timestamp into the block header. So what the Bitcoin protocol does, it then looks at all of the blocks in sequence and looks at what is the average block time. Now, we've got marked out here in black is the target block time. This is the protocol, what it will adjust the difficulty to try and get that block time in line with, and that's 600 seconds or 10 minutes. Now, you can see that through periods of time in the orange and being quite noisy, there's natural variability in when blocks are solved. But this orange is the average block time, so in terms of seconds. So when it's dipping down below the black line, it's essentially showing that the overall block time is faster than what's going on with the target. So the difficulty during these periods where mean block time is below the target, during this period, which is generally bull markets, as miners are expanding their operations and more hardware is coming to market, blocks will be coming in faster on average. Now, every 2 weeks, the Bitcoin protocol will make the puzzle harder. But if we have an expansion that occurs over the course of that 2 weeks or across that boundary, this is why we get these expansions where the actual block time is less or shorter in duration. Blocks are coming in faster, more hash rate is being applied. Now, typically, 2013 being a good example as we move into more bearish territory and miners essentially have to wind down their operations or at least slow their expansion, the Bitcoin protocol has time to get the difficulty back in line, and we see this uptrend in overall mean block interval. So we're seeing that blocks are starting to come in a little bit slower. It's actually moving it back towards the target. So rather than a period of expansion where faster blocks come in, here we're looking at slower blocks, and it eventually converges back to that mean block time. And you can see that we have, here's another example. We mentioned this ban in May 2021, where we had about 50% of the network turn off over the span of about 1 to 2 months. It was a very, very fast and rapid change. And you can see here, it's historically the largest change that we've ever seen. Now, during that brief period of time, blocks really slowed down. They were coming in much, much slower because over that period, the difficulty took time to actually wind down to address where the new mining hash power was, as 52% of them almost switched off overnight. But you can see how quickly this actually returned back to its original trend. You can see the difficulty wind down and the overall hash power, even if there's not more hash power coming online, the block time gets returned back to its equilibrium of oscillating around this 600-second interval. Now, from those, we know the complexity of the puzzle from difficulty, and we know the observed outcome, which is the timestamps and the block interval. So from that, we can then estimate the mean hash rate. How much hash rate is required in order to solve this particular puzzle when we're observing this result? That's essentially how we calculate hash rate. Now, with those metrics before, particularly the block interval, you can see it's quite noisy on a day-to-day basis. That's why we had that blue curve, which was mapping at that 14-day median. So when we look at hash rate, it is advised to put some kind of roughly 14-day moving average or a moving median because it smooths out that daily noise, and also because it's naturally variable. If you take a single daily data point, it can be misleading. So you may see an all-time high on a daily data point, but in reality, that's just a series of blocks that happen to come in faster. It's a probabilistic process of solving these blocks. So you can see here with a 14-day simple moving average, it's much, much smoother. And we can really see when miners are starting to switch off their rigs in bears. We can see the expansions during bull markets. We can see this particular band here in May 2021, which was quite significant. And you can also see the significant recovery. So note here that we not only saw all of the rigs that were switched off in China, they were relocated, rehomed, some of them are still there, and we've seen those come back online, and we've also seen additional fleets come to market. So you can see that we actually have had an expansion of the mining industry. And we're going to touch on this shortly because this is quite important when assessing revenues and potential capitulation risks. Now, why do miners actually apply this hash power in the first place? Well, there's two sources of income for them. The first one is the block reward, which is essentially the newly minted coins up to that cap of 21 million. And this also undergoes the halving. We'll explore that more in a second. The second source of revenue is from Bitcoin fees. These are transaction fees that people are actually spending their coins, moving value around the system, and paying that transaction fee in order to do so. So here we have plotted out the Bitcoin fees. This is the total amount of fees paid per day in BTC. And you can see that generally during more bullish markets, we tend to get these upticks. And particularly as you can see here in 2017, there was a period of significant spikes. Now, what this is speaking to is the urgency. People really wanted to get their transactions confirmed. There's also more people coming into the network. The awareness has expanded. We're seeing that there is more congestion on chain because block space is a limited resource. There's only so many transactions that can fit in each block. So if there's more people trying to get their transactions confirmed than the system will allow, you end up with congestion and people have to pay a higher priority fee if they want to get theirs mined in a near-term block. So we generally see an expansion in transaction fees during bulls, and you can also see that we see a reduction during bearish markets. We see less activity, there's less attention on the space, and over time, we do see these kind of bull and bear cycles play into it. Now remember, that's not the only element. The cycles are certainly part of the mix, but there's also things like transactional efficiencies. So we can see through the period of 2021 and 2022, we did have a more depressed market cycle, so that is certainly in play. But there was also an additional upgrade in terms of adoption of SegWit, which allows more transactions per block, which is going to reduce overall congestion. And there was also exchanges, particularly from 2020 onwards, adopting transaction batching. So rather than sending one transaction per withdrawal, they would send a transaction every 10 minutes or every hour, for example, and process all of those transactions in a single go. So more efficiency in terms of the way that exchanges in particular are actually using that block space. And they account for about 40% of block space at the time of recording. So when we combine the transaction fees in BTC with the actual block subsidy, that's the reward coming that pushes us towards that 21 million cap, we end up with our total block reward. So there's two components. There's the block subsidy, which is the amount of new coins that are minted. There's the transaction fees. And when you add them together, you get the total block reward. And you can see that over time, this has been gradually descending in BTC terms. You can see the halving events here where we actually cut the block subsidy in half. You can see that it generally trades at a fairly stable level. This is monitored by the difficulty protocol and the block interval. And then each halving, we get this consistent amount of coins mined per day. This will fluctuate more because we have the transaction fees. You can see here in 2017, we got more of that income being sourced from transaction fees and the subsidy. But generally, we see these plateaued levels, which is largely driven by that subsidy level being kept in line, that deterministic curve of the supply, as a result of the difficulty protocol. So that's really keeping things in line. And this is why we can actually predict Bitcoin's overall supply well into the future. Now, of course, miners, their costs, whether it be in buying hardware, whether it be in power contracts, logistics, paying staff, their costs are normally denominated in fiat currencies. So whilst their reward comes in BTC terms, their actual revenue should be priced in US dollar terms or fiat currency terms, because that's what their costs are imposed in. Now, when we actually overlay, so even though we have our total block reward, which is over time halving because of the halving events, and we also have the transaction fees, which are somewhat cyclical in nature, in terms of their actual revenue, we can see that if we look at our current market structure, even though we're near all-time lows in terms of BTC denominated revenue, you can see that our USD denominated revenue is much, much higher than it was following the last halving. So over time, miner revenue in dollar terms has actually been on the ascent. And we've seen this through multiple cycles. You can actually see that back here, we've more or less lost that prehistory because it's essentially insignificant relative to our current market pricing. So really, when we're looking at miner stress and income levels and where we are in that cyclical performance, it generally makes a lot more sense to pay attention to miner revenues in fiat denomination rather than in BTC denomination. So whilst we are seeing that decline over time, miner revenue in fiat denomination term continues to climb. And this is really that point of reference for a lot of these metrics we'll look at moving forward. Now, because the mining cycle is reliant on the coin price, like any commodity industry, that goes through boom and bust cycles. And there is a process in terms of actually tracking this, and we have tools available such as the difficulty ribbon. So as I mentioned, difficulty will climb and descend and adjust itself according to the actual observed block times. Now, during bearish markets, when you see miners that are actually having to turn off their rigs, what happens is when miners turn off their rigs, the miners who remain on the network gain their share of overall hash power. So what happens is that miners who potentially are over leveraged, have overcapitalized, they haven't run their operations as smoothly, what we would classify as weaker miners, they will have to turn off their rigs to conserve power and essentially stop expending that OPEX. Now, the miners who have more efficient or better or cheaper power contracts or whatever it is that makes them a more efficient or a stronger miner, their overall share of the hash rate will increase. So that means that the BTC reward, more of that reward is going to them per day than it was before. So their revenue actually increases on a relative scale whilst the other miners are turning off. Now, as those miners turn off, the difficulty will start to adjust down. And we can actually see that the faster ribbons, the difficulty ribbon is just taking moving averages of difficulty. And we have everything ranging from the 9-day up to the 200-day. So the bluer curves are the fast ones, the red curves are the 200-day and the 128, which are much slower. And as this capitulation takes place, the faster moving averages will descend below the slower ones. So let's zoom in on our last 5 years and we can really see this in detail. We can see that the blue curves dive below the red ones. This is showing that difficulty is winding down. And when we get these inversions, it has historically coincided with capitulation events when we're getting close to the end of the bear market. Miners, once they've spent money on their hardware, generally because that capex has already been expended, they will keep operating their miners until the operational costs exceed the revenue. So it really comes down to that power costs and maintaining the machines running because the capex has already been spent. So they will try and recover that fund until it is not even worth it on an operational standpoint. And generally, that's after an extended period of depressed prices and often at the end of capitulation events. Now we can see in March 2020, we actually had what we would call a double halving event. Price halved in the March 2020 COVID sell-off. So we actually saw miners have experienced a miniature capitulation at that point too. And barely a few months later, we actually had the actual halving, which again halved their revenue. So we actually had 2 capitulations back to back. And then you can see here very clearly this May 2021 event where China essentially banned all mining operations within their geography. And we saw over 52% of the hash rate turn off in a handful of months. And this signified a major capitulation event. Now, why these capitulations are important is that miners build up BTC denominated treasuries. And when you see these major costs imposed, whether it be via expansions, whether it be because the overall coin price has declined, they need to sell more coin to cover the same fiat denominated costs. And often during the end of these capitulation cycles, they will have to dip into their treasuries to cover these costs, which increases the amount of sell side pressure that's coming to the market. They have fixed USD denominated costs, but the price of their income, the actual commodity that they are mining, is losing value, so they must sell more of it to cover the same costs. So just before we finish up, just wanted to introduce you to some of the mining metrics we have under a Glassnode Advanced plan, which really try to take this to the next level and show you even more insight into what's going on. So we can look at things like the difficulty ribbon compression. This is really taking that difficulty ribbon concept that we looked at and mapping it out into an oscillator where we can see when we enter these periods of mining stress. It's actually mapping out where those moving averages are really reaching that point of capitulation. We can also look at a metric like the miner revenue per exahash. This is where we're looking at an individual miner or miners as a whole, looking at what their revenue is in comparison to the entire market. So in other words, we can look at how much revenue is coming in per exahash on the network. And from this, we can start to calculate things like the average cost to mine a Bitcoin. We can pull out more information both at a macro level, but also at an individual miner level. We have oscillators like the Pure multiple, which maps out the average miner income over the compared to its yearly average. And you can see that this tends to fluctuate between extremes of very, very low values during miner capitulation when their incomes are very, very stressed, and all the way up to very high values when miners are in extreme amounts of profit. And that's typically around cycle tops. So you can see we can develop these cyclical oscillators that also takes into account the halving events. And then we have the mining pulse, which is one of these metrics. It's actually quite interesting. It's mapping out that concept of faster and slower blocks. And we can much more easily see these periods of miner capitulation where we have these large slowdowns in block times. And we can see when we get large expansions in the mining hash rate, when we're seeing more miners coming online and mining at a faster rate. And lastly, we have the hash ribbon, which is very similar to the difficulty ribbon, but really looks at it from a hash rate perspective. And you can see in these areas marked in red, this is where we get an inversion of the hash ribbon, where we actually see that the faster moving average cuts down below the slower one. And this typically signifies that miners are entering that period of income stress. And when we combine that with things like the Pure multiple or the mining pulse or any of the other metrics we've looked at, we can really start to get confluence for when the miners are under serious stress. And again, this typically comes towards the end of bear markets. So thanks for tuning in for this session. Hopefully you found this useful as a bit of an overview of the mining fundamentals. Hopefully you learned something new about how these different mining metrics come together into a single cohesive piece. And we are going to explore the concept of mining metrics and how we can really track this in even more detail and look for various expansions versus revenue declines. We will look at this in future videos to really explore this in even more detail. So until the next one, I'll see you then. Cheers.